Varun Lohchab of HDFC Securities is joining us, head of institutional over there. Varun, nice to be speaking with you after a long while. Before we talk about sectors and the area which you have looked at very closely, consumers, first I would like to understand what's the strategy right now, the way earnings are set to unfold this quarter, how quarterly updates have been on the operational side versus by and large how the market is trading at operationally. Is there some amount of divide within that, or are they in sync?
See, clearly, earnings performance has been improving. Q2 was a strong quarter, which led to upgrades after a long time for Indian markets. And, from there, the markets really took off. Now, I think while Q3 earnings performance will again be strong, is our view, given the demand conditions have remained reasonably good. There was bunching up of festive season this time around more in Q3 than Q2. And there is still a bit of pent-up demand which is there. So I think Q3 earnings season will be strong, more or less like Q2. Cost efficiencies, which were a key driver of margin expansion in Q2, will largely sustain into Q3 as well. But I think the difference is since then the markets are up around 30%. So, I think valuations at a headline Nifty level of around 22, 23 times FY22 are starting to get us, slightly stretched. But we believe it's a very stock picker and bottom-up sort of a market. This calendar year is going to remain, that way. That you will have certain parts of the market probably still moving up, where there is some room for valuation re-rating and earning upgrades might continue. Whereas there would be some part of the market where valuations have already reached peak levels, and you might have some disappointment. So rather than looking at headline Nifty or getting too worried or positive on markets per se, I would say, bottom up, we still see opportunities across a lot of sectors. And that's how one should approach the market for this year.
Varun, give us a view on what kind of model portfolio are you working with when you're talking with your clients? What is the kind of portfolio tilt are you having, or the mix of your coverage? If you could indicate some themes or stocks, or what kind of conversations are you having around your model portfolio or your coverage list with your clients?
Sure. So when I look at, say, in the defensive sort of basket, where I would put, say, IT, pharma, consumer staples, these three sort of, evergreen kind of sectors with very high quality companies and sort of defensive business models. We were overweight IT. As a house, we have been fairly positive on that theme for last 6-9 months. We still continue to be slightly overweight out there. While valuations have run up, we believe the starting point of valuations was quite attractive. And given the pickup in earnings growth, I think IT sector might, remain in limelight and through CY21 as well. So IT and pharma, we were slight overweight, and consumer staples, we were underweight given the fact that, valuations were probably the richest within those three defensive baskets out there. Consumer discretionary, again, we are underweight. And in fact, now the valuation gap between consumer staples and discretionary has widened. Staples is at a good discount to consumer discretionary. So in fact, consumer staples, we are turning slightly more positive or more balanced now, closer to equal weight in our model portfolio. But consumer discretionary and autos, we are still underweight. Chemicals, we are overweight as a sector. We still continue to like it despite very strong, share price performance last year by the key stocks. Life insurance, we are positive. Large banks, we are positive. So while financials overall, we are equal weight, but we only have the top 4 or 5 banks in our model portfolio. So we are slightly overweight large banks. We are underweight NBFCs. We are underweight oil as a space, but we are overweight gas as a space. And cement, we are overweight vis-a-vis metal. So that's how broadly our model portfolio is positioned. And we have a fairly good mix of large cap, mid cap, small cap. So it's like, wherever we see opportunities, we have been, adding those stocks irrespective of the market cap.
how are you analyzing the valuations of the broader market? And is there interest from your clients towards that?
See, liquidity has clearly lifted up valuations across the board, and it's not just the case in India. I think it's a global phenomena where valuations have been running on the higher side, but we are also in historically low interest rate environment. So, if you believe that these low interest rates will persist for a few more years, then probably valuations can probably sustain out here, because valuations are inversely related to interest rates. So rather than taking too much of a macro call on when interest rates will rise and when valuations will probably come off a little bit, what we are trying to do more is look at relative attractiveness of certain business models within. So one is you do stock picking within the industries. Secondly, you do kind of across sectors where you see a better risk reward, and obviously it's a rising tide would lift all boats. But whenever say the liquidity gets withdrawn from global markets, including India, you will see a sharp volatility. So one has to be prepared for those kind of volatility bouts if you are invested in equities, and especially at current levels, you are always prone to a 10, 15, 20% sort of a sharp correction. But in those corrections, you have to again go and buy, the business models which are robust and where you have more conviction on in medium term. So that's how we are approaching the markets.
Right. Varun, you look at consumer space also closely. The commentary from there is good. Price hikes have happened. Volumes also pretty healthy. What are your thoughts on the consumer universe, on the fundamentals of the space versus the valuations they are trading at?
So, consumer staples, again, as I said, you will have to probably, dissect between, say, consumer staples and discretionary. Consumer staples is anyway, low volatility in earnings as a space. We never saw any big sort of contraction of demand even during the pandemic, when the pandemic was at its peak. Whereas consumer discretionary saw, very poor Q1, but in consumer discretionary, the demand rebound has been quite strong in areas like paints and, consumer durables and appliances. So like consumer durables and appliances, we have a positive stance, and we have few stocks in our model portfolio. Paints, QSR, retail, some of these consumer discretionary segments are looking quite stretched on valuation. So we are cautious out there. The recent run-up in the last 3 to 4 months has really made valuations very stretched at 80 to 90 times 1 year forward P. So we are unable to justify them. Consumer staples, I think, is again starting to look better. It has underperformed Nifty by around 40% since April, when the fear was at its peak. And now in context of relative valuation versus some of the other sectors, select FMCG stocks are starting to look better to us. So we have recently upgraded a few of those stocks from reduced to add. Stocks like Dabur, GCPL, Marico. We already have Colgate, United Spirits, and ITC, where we have a positive rating. So I think consumer staples is starting to look okay, given the fundamentals, quality of businesses, and where valuations are. They are not cheap. We are not calling for a big valuation re-rating out there, but you can get returns in line with the earning growth, which will be in double digits in FY22. So I think consumer staples looks okay. Consumer discretionary looks slightly stretched right now on valuations.
All right. One quick word, last word, Varun. Does it appear that we are in a 2-3 year kind of a earnings upgrade cycle and expansionary phase of the market cycle, the way all the things are coming together?
I think too early to call whether it would last for 2-3 years, but clearly I think FY22, it looks like the chances of upgrades are slightly more than downgrades, because while almost a mid 30% kind of earning growth is built in for FY22 when we do our bottom up numbers for our coverage universe, HDFC Securities, Institutional Equities sort of coverage of around 160 stocks. But a large chunk of it is because of earnings rebounding from very depressed levels in sectors like financials, sector like oil, and we believe if these are very heavy sectors in terms of the earnings. So while we believe that there is a chance for some positive upgrades on these sectors in FY22. So clearly, I think FY22 the chances of upgrades look good, and therefore I think earnings is something which we are less worried on at this point of time. It's more the PE, what valuation are you ready to pay for those earnings, and that's where you have to take that call on which stocks and sectors to back. Till what point are you comfortable with valuations on each of the stocks?
All right, Varun, thanks so much for your time. Great chatting with you. Look forward to having you on the show more often from here on. Thank you very much for your time. With that short break, on the other side of the break, more important news and market moving stories. Don't go anywhere.